Thank you all. Apologies for the technical glitch. Hopefully we're all working now and you've got the sound and the pictures and all those sorts of things. My name is Garry Crole. I'm the CEO and Managing Director of Sequoia. And yesterday we presented our results, and I'm sure you've had time to have a look at those and digest the financials. What I'm looking to do today is to discuss those. Most importantly, look to take questions from those in attendance, and aim to give you a bit more colour around the financial results and the completion of the Morrison sale, what we're looking to do with our capital, our dividend policy, etc. I will move to the disclaimer page. I won't spend too much time. I've talked about this before. The disclaimer is quite important to Sequoia and a financial planning organisation because we do give personal advice. This disclaimer is the fact that we're not giving any personal advice on this occasion. It's general advice only and factual only, and no one should look to make a financial decision based on the contents of today's seminar, but get personal advice in respect to that. I'll touch briefly on the full 23 year results, but as I said before, the major purpose of today is to talk about the future, what we've done. On occasions and over the last few years, I've talked about us being the tortoise, not the hare. And the full year 23 really, our shell cracked. And what we've done is we've looked to strengthen the business and maybe take a step back in some ways to make the business a far stronger business and to provide stability so that from full year 24 we can go back into growth mode. And we are very confident that the full year 23 has been a terrific year of transition, a terrific year of cleanup, an opportunity for us to strengthen the balance sheet and place us in a really good position to still continue to look towards our longer term target, which we have extended for 1 year. So we set a target of full year 25 to be looking at $300 million revenue at an 8% type return on that revenue. We've pushed that out to full year 26, but I think this year in particular has been a year where that aspiration can become reality because we've spent a lot of time looking at those areas of the business that may not be performing as well as they maybe could, and made some decisions that are looking to the long-term future to really improve the longer-term returns. And that's come at a price. Obviously, revenue has been down, and the operating profit that we report of $5.5 million is well below what we would hope to have done. On a normalised basis, adding back some abnormals, that's come in at around 9.5 million, which is acceptable, but certainly not what we're looking to do. We're certainly looking to continue to improve on those numbers over time. Some of that was outside of our control. Clearly, the equity markets have deteriorated. Inflation has arisen, interest rates have gone up, and the number of the financial advisors in the marketplace is retracted. However, Sequoia has continued to grow the number of advisors that we provide services to, and we're in a strong position to be able to improve those numbers. We made a transformational asset sale, which completed yesterday, and that was mainly the reason for delaying our results to the end of August. Traditionally, Sequoia is quite keen to report early. This year we decided to wait until this sale completed so we could report and tell shareholders that we have received the full $40.5 million for our divestment of Morrison's. And because we didn't account for that in the full year 23, we weren't able to pay a dividend using franking credits in full year 23. So we delayed that decision, and we will announce in the next few days a special dividend of 4 cents per share in September, which will be paid in September, which in reality is 100% of our net profit after tax and amortisation, or our operating earnings after tax for the full year 23. So 4 cents per share is around about $6 or $7 million, and that's but moving to the strategy where we discussed some time ago that when we got this capital, we would move towards a 90 to 100% fully franked dividend on NPATA, or operating earnings after tax, and that's really what the 4 cents per share is. The cash at the bank, as of today, is approximately $40 million, and that's a good war chest. Obviously, we'll pay $6 million out of that in dividend, and we may use some of that to initiate buybacks. So, we did, whilst I said 23 was a disappointing year in some ways, there were some highlights. The licensee services business, in a market that saw advisor numbers detract significantly across the market, 30 to 40% of advisor reduction over the last few years, we were actually able to increase the number of advisors under our licenses by 5%. And that was at a time we actually gave notice to the Libertas advisors that we were closing that business down, and offered them the opportunity to potentially join Interprac or Sequoia Wealth Management, or to actually look to find an alternative license to join. So we, in the financials, we wrote down the value of Libertas, so that had an impact on the EBITDA and net profit after tax in this financial year because of that. But the positive thing is, despite that decision and that write down, most of those Libertas advisors did join one of our licenses. And in addition to that, the net gain was about 5% of advisors. In fact, Sequoia Group was the #1 growth licensee in respect to new advisor numbers net from January 1, 2023 to the current numbers, according to the data that's coming out. So that's a particularly good result. We're net 5% growth of about 20 advisors. So that includes advisors that retire, leave, etc. But we're net up, and we are continuing to have a very strong room of inquiry from advisors looking to join us. That's not to say that we aren't prepared to make further acquisitions in the space. We are, but we're not looking to buy licensees as such. We're looking to offer those looking to exit a license an opportunity to join our existing and not have too many multiple licenses. I think the market can see by Insignia's decision to close some licenses and consolidate that that's a better strategy, and we are following that same strategy. We slowed down on the acquisition front this year. As I said, it was a year of consolidation. We did make some acquisitions, and we will continue to make more acquisitions now that we're cashed up. We made an investment in Uri Asset Management, where we took 20% equity in a fund of funds opportunity that we think is good, but is going to be a successful decision. I'm pleased to say that in the 2 to 3 months we've held that investment, Uri has been able to get a 3.75 and 4-star rating with a research house. It has got on 2 platforms. It's now ready to take money in, and we're very confident that decision will be a very strong financial decision for us. In the last few weeks, we've completed the Castle Corporate and Castle Group acquisitions, which really complements our professional services business and will add strong EBITDA and create further synergies for our existing business in that space, which we're very pleased with. The financial year 23 result was, as I mentioned before, was not significantly great, but the first half was particularly the problem, and the first half of the second half, or the third quarter again was soft, but the fourth quarter of full year 24 was actually strong. And I think most of the repair work that we did throughout 23 and the hits that we took throughout 23 began to become evident that we'd made some really good decisions around April, May, and that's played out into July, August. The July, August results for the start of this year are very strong, and we're back on the sort of targeted growth that we would hope to do, and that gave me confidence to make some additional changes and some restructure. We've gone from approximately 115 employees to around about 100. But at the same time as doing that, we've enhanced our leadership team by appointing a new COO who's got background in superannuation administration. He's got background in licensee services. He's got background being a head of growth and sales teams at Praemium. Martin Morris joins us in that role. He's only been with us a couple of weeks, but already it's evident that he's going to make a significant contribution to the business. We've appointed a head of legal and risk. who is a lawyer. We've had some issues over the last few years with some claims where we've attempted to get recovery from our insurers. That's stalled. We haven't had as much success as we hoped. We certainly haven't given up, and we're continuing to look for resolution in that, but there's no benefit of that in this year's financials. However, that decision to make this appointment will accelerate that and have a dedicated role to follow up that, and also make sure that we reduce that exposure that we had back in 2019 to 2022 that we don't see as an issue now, but we're addressing that. And we also had another senior compliance manager join us from ASIC, just to give us additional strength in the surveillance, education and supervision of advisors. The numbers in particular, are down. Revenue is down 10.7% in the year. Part of that revenue drop is because we changed the way we reported professional services in some way. We used to report for the ASIC fees in our revenue. We're no longer reporting the ASIC fees in our revenue. We're also no longer reporting the contractor revenue as part of sales and direct. So on a like-for-like basis, I think the change in revenue is actually quite a lot lower than that 10.7%. But moving forward, we expect revenue to be 20 to 25% up on 23. We're very, very confident we're going to see a large jump in revenue this particular year. And that's without acquisitions, and that's taking into account we won't be reporting Morrison's results. So the revenue growth is particularly strong in professional services and particularly strong in licensee services in the first 2 months of this year. And that gives me confidence without acquisitions, which we do expect to make, that we're going to see a jump in revenue. The gross profit number fell, but again, that's something that we've addressed. There's been lots of abnormals and lots of expenses that we've taken to improve the business, and we do expect that to normalise and get back towards, a conservative $10 million operating profit in 2023 without abnormals. So the operating profit for 2023 was 5.5. If you add back the 4.1 million of expenses that we don't think are recurring, we're about 9.5, but we expect to improve on that this year. I identified a term that I read on some of the chat lines that I've invented, which I probably have, and I've called it ROAM. So basically, return on equity is a characteristic a lot of the industry use, but one of the challenges, in my opinion, with return on equity is what is the equity value of each business. So I've come up with a valuation of each business unit that I and the business determines as a fair value, and what we're looking to do is achieve a 15% return as our target on that equity, and I'm disclosing what that is. And as I touched on earlier, we have not moved away from our longer term goal of 300 million total revenue and generating 8% return, but instead of moving towards full year 25, we're now expecting that to be full year 26. So 1 year out, but still a very ambitious and target that I'm quite happy to let shareholders know that continues to be our aspiration. More importantly, or as importantly, the 15% return on management equity is really the key number for me. We divested one of our assets that we certainly had no desire to necessarily exit when we acquired that, and we've been building that, and we continue to have equity in Morrison's. It's like losing one of your children in some ways. The Morrison business was very important to Sequoia, and it is a closed loop. But we determined a valuation that we thought we could generate 15% return on that equity. And the price that we were offered to dispose of that was higher, and significantly higher than that number for us to consider disposing. And we have obviously made that decision. So no businesses for sale, but I think if you're realistic in this in this world, our market cap is $65 million. If someone comes to you with a price that's above the perceived carrying value of us at this point in time, where they can generate much higher returns on that business because of the synergies that they create, we would accept it. So I'm moving to a point where, rather than just disclosing the equity on the balance sheet of the carrying value, which is $20 million on their balance sheet, quite low, I'm actually sharing with shareholders what we believe the current value of each of our divisions is, and what my expectation, what my goals are for my management team to deliver on each of those businesses. If we cannot achieve those numbers, we must repair, sell, or repair, close, or divest, and that's been my message since 2020. And I'm sharing today, yesterday in the financials, but again today, that licensee services, we think fair value of our licensee services business is 40 million, which means that we need to generate $6 million of EBITDA from that licensee services business to be fair value. So we believe we can generate that type of return over the medium term, hopefully this year. And the same thing with all the other 4 divisions. I think the key one that's worth talking to is the direct division. So 2023 was a very, very difficult year for the direct division. We made a couple of acquisitions that probably we overpaid, and we probably haven't been able to generate the type of return I would have expected. We've made some decisions around April, May to change the management team, restructure, reconsider our offer to our clients. I'm really pleased to confirm that business has turned around, and I'm really also pleased to confirm that we do believe we can generate 15% return on that business moving forward, and therefore comfortable that the carrying fair value from my perspective is $5 million. So the sum of that is $85 million, and 15% of that is a $12.75 million target, less head office costs. Our budget that we've given the management team is less than that, and the budget that we're confident to stand here and say that we can deliver is $10 million or $7 million after tax, which is about the 4-cent dividend. So if we're paying out that sort of return, the special dividend is really in line with what we thought it was going to be the longer term dividend. So we're looking for between $9 million and this $12.75 million of EBITDA operating return in 2024, and we'll be doing everything we can. So that's a high number, but it's a number we're confident with, and it's a number that we're looking to generate. It's a number I'm looking for each of our divisional heads to aspire to. It's the number that the CFO, Lizzie Tan, and the COO, Martin Morris, and myself are benchmarking ourselves against. It's certainly higher than we've delivered in the past. It's certainly higher than the market's expecting, but I'm quite happy to go on the record that that's where we see the value of each of these businesses. That is the return we need to generate to make sure that we maintain those businesses, and that's the sort of return each of the management team in those businesses is expected to look to aspire to from my perspective. In addition to that, sum of parts of $85 million, we obviously have $40 million of cash, but we also own the 20% stake in Yuri, which was valued at around $1 million. And we also keep our remaining 20% stake in Morrisons. And if you look at the valuation we sold 80% for, that arguably you could suggest that's worth $10 million. So, that's $50 million. So that's a market cap of far, far higher than our current share price. And that is why we're going to continue to commence the buyback. And it's also the reason why we're not giving. That's the reason why we want to keep as much cash as we possibly can. Happy to pay out the 100% operating earnings after tax, but we want to keep as much cash as we can whilst our share price is its current price, because we do not want to use this current share prices as our method of making acquisitions, unless of course they're very large, and unless of course the business we're buying is going to become part of our very long-term management team. Outlook. I think I might have touched on that already to some degree. So all divisions, as far as I'm concerned, we've put a number on what we think they're worth, and all divisions to achieve the tick as far as the management team is concerned and the business itself is concerned, noting that we have invested in full year 23 to repair many of these. I'm expecting this 15% roam by division. So, ideally all 4 divisions achieve that and we're going to outperform budget. But I think, as everyone would know, that doesn't always happen. But that is certainly what I'll be looking to make each division accountable for, and everyone's buying into that. There's a lot more synergy than maybe there has. I think maybe the shake-up of the full year 23 results been good for the company in respect to a wake-up call. I've talked about the tortoise and the hare. Maybe our shell needed a little bit of repair and we put it on a tougher shell, and I think we can continue to grow long-term revenue, continue to deliver the type of returns we want. And now we've got the cash, we can start paying out fully franked dividends. The 4 cents on our current share price is an 8% fully franked yield. We think that's an attractive yield. I think we can continue to pay that type of dividend and hopefully grow it. If we reach our aspirational target of $300 million at an 8% EBITDA margin through organic growth and acquisitions and improving the operating performance of the business, obviously it's going to be a lot higher than that. And that's really what we want to do. As I said, we will look to recommence the buybacks slowly but surely. So we're going to be the tortoise there. Every investment we make, we're not looking to rush in and make an investment just for the sake of it. We've got a pool of cash. We'll be very careful with that pool of cash. We'll be looking to make investments where we think we can get the 3 times earnings benefit from it. And I think the Sequoia share price is not much different than that. So we won't be aggressive on the buyback, but where they're selling, we will be there looking to buy back the stock over a period of time. And as I said, in coming days, we will make an announcement in respect to the X date for the special dividend, and we are looking to pay it in September if possible. I'll move to questions. If we've got some questions, I think that would be far better to hear from, and I'll look to answer those questions so that we can address those. I think there's a place on the internet on the
Teams meeting. Yep, you can. There are some questions that have come through.
Thank you.
The first one is, you state shareholder returns through buybacks, dividends, and capital returns will continue to be a focus. Do you have much of a franking pool to use for potential future dividends?
Yes, we do. We have approximately a $14 million franking pool, and because financial year 24, we've already banked approximately a $25 million profit that will come through the full year 24 numbers in respect to Morrison. So, and we are forecasting a normalised earnings of a 10 million. So, it's very likely that we're going to have $30 million plus profit in full year 24. So that's going to add another $7 or $8 million of franking credits. But we have 13 million already. This special dividend, we're using about half. I would expect the dividend, based on our budget and forecast, would see us pay out the same type of dividend in 24. So, probably within 18 months, we would have used our current carrying balance of franking credits, I believe. But we expect to continue to make profit. We expect to continue to pay out 100% of NPATA, which means that we can generate future franking credits from that and not need to pay from excess credits.
Okay. There is a question that has come through the webinar. Mention was made of applying the surplus capital towards buybacks. Based on the valuation of the company, that sounds to the shareholder like a great idea. However, arguably it works against the 300 million at 8% margin objective. How does the board reconcile these two seemingly opposing objectives?
It's a really good point. I'm not against raising capital for acquisitions at the right price. What I'm hoping occurs is that through sharing our message and giving the market more confidence in our performance, that the share price reaches a point where it's closer to what we perceive as fair value. and buying back stock that's obviously stale or no longer wants to participate in what we think is a great long-term story of revenue growth, EBITDA growth and dividend growth. We would hope that we can complement that and then use a mixture of shares and capital, of new capital for growth. But absolutely, there's no doubt that it's going to be a balancing act over time. The challenge for Sequoia for quite some time is not having enough cash in the balance sheet to be able to make acquisitions with cash, at the same time having a share price that we've continued to argue has been undervalued. The good thing about now is we do have enough cash. So if we're buying businesses at 3 to 4 times earnings, we've got enough cash to potentially buy $10 million of EBITDA. And I think that will be very positive for shareholder growth and put us in a position to move towards that $300 million revenue and 8% return target. So we're currently at $10 million EBITDA. If we use that $40 million well at that type of metric, arguably you could add another 10 if you do it well. So we're not far away from that $24 million longer term target over 4 years, but we're not going to spend the money quickly. We're looking, and I've been in discussion for the last 12 months looking at a number of opportunities, and we're not in the market. One of the challenges that happens is when a small cap company like Sequoia gets a pile of cash, is that you don't use it well, and you're like the boy in the lolly shop, and you want to buy all the lollies. We are not going to take that approach. I've been in this market for 40 years, and I've seen markets. The financial services sector be very bullish. I've seen the financial sectors be very bearish. We're currently in a bearish market, which makes us, from my perspective, with some cash, it's a good buying opportunity, but we're not going to buy for buying's sake.
Okay. We have one more that's come through in another format. I think you might have touched on it towards the end, but we'll maybe just again. FY23 was obviously a difficult earnings year, but can you give an update on recent trends across the 4 businesses as you aim to achieve that 15% returns?
Yep, sure. So all 4 businesses, all 4 divisions have turned the corner from about April 23. Professional services, the acquisition of Castle looks very good. The integration of Panther Corp, Constitute, NCAA Corporate with Castle and the SMSF admin business has really placed that professional services business in a strong position. We had record sales in June. July was very good. I haven't seen the August numbers yet, but the professional services numbers are really strong. The licensee services numbers are even stronger. From May, June, July, August, we've seen a spike in the revenue that each advisor is generating. So clearly the market is looking for advice. As inflation rises, superannuation returns are inconsistent across managers and industry, and that's seeing a number of advisors really increase the level of new clients they're generating, and that's passed through to our numbers. We've seen a major spike in revenue per advisor. At the same time, we've had an increase of the number of advisors by 5%. So that's a net increase of numbers by 5%. We did lose a part of our tail. The advisors retiring or the advisors that decided to no longer stay in the industry, we did see 30 odd of those leave us or retire. But at the same time, because we've had a net 5% gain, we've picked up advisors with much higher income, much more stable businesses, and that's showing on the revenue line. So licensing services is a standout so far for July, August. We're very pleased. The direct business was a major underperformer in 2023. We made some changes in April. May and June showed some signs of improvement. July has shown a significant change of trend. And in August, we've signed a couple of new contracts and a couple of new joint ventures in that particular business. And Paul Sanger, who's running that division, and his team Peter, Abby, and so on, and Adrian and Arena in the media side have done a terrific job. We are absolutely flat out that the type of initiations that we're being asked to have a look at has increased. So I'm confident that that particular business has turned the corner from, losing $600,000 or $700,000 cash to looking to make $600,000 or $700,000 of cash this year. And the final one, the equity markets one, well, obviously we don't have the Morrison's business anymore, but we made a decision in the specialist investment products over 22 and 23 to slow down sales because we were expecting interest rates to rise, and the cost of protection and the cost of those types of products was difficult to predict. We're now confident that interest rates are likely to peak around December 23. We're also seeing the pricing of options and some of the opportunities, particularly in commodities, bonds, hedge funds, where you can use protection and that type of product being far more attractive for the end user, and we've recommenced the marketing wheel in that area. So we do expect those numbers to improve, and we're confident that that division can make a serious contribution to our numbers. So all four businesses are heading in the right direction. 23, as I touched on, has been a transitional year, but one we probably had to have. It restated from me that you must be the tortoise, not the hare. We put our protected cap on, and I'm really confident that steady but surely will be the Sequoia story in 24.
Okay. We haven't had any more questions come through, so we might wrap up there unless there's anything else you want to add to finish off.
No. I will just sort of finish with, I'd really like to thank the shareholders that have supported me over the last few years, and the institutions that have continued to support Sequoia, introduce us to opportunities and be supportive on the buy side and hold shares because they believe in what we're looking to do. I think it's really important. Groups like Sequoia, Centrepoint, Diverger, Count are strong and making profits. I think our competitors like us are talking full year 24 and beyond as being a more positive sector. I concur with that. I'd also like to thank our 100 employees. I'm very proud that Sequoia is a business that can employ 100 people and provide for their families and give them security in a marketplace where inflation and house prices and the economy is challenged, and those employees and the 350 odd advisors that are out there, talking to clients every day and improving the lives of those that get advice over those that don't get advice. I'm really proud to lead a team like this, and I'm confident that we're making a good contribution to the industry and also providing a good mix between providing a comfortable workplace for our employees, a secure workplace for our employees, but also at the same time generating a good return for our shareholders. And I think the 4-cent dividend and the strategy where we're looking to now pay out that type of ratio, so that's a normalised dividend, and increasing over time is one we can believe. When I come into the role, our share price was 20 cents. The share price, whilst I still believe it to be under a fair value at 50 cents, is a good return. And if you look at the 4 cents on that 20 cents, without raising any capital in between, I think talks to the opportunity. So I think the market might not necessarily respect that as yet, but I think over the long term, if we just keep our heads down and keep delivering, and I think we can, hopefully your share investments will be, the value will be more fairly reflected. And I can assure you, me, Lizzie Tan, and all of our team are doing our best to generate a positive return for shareholders. And I thank you for listening and your support. Thank you.